Hi everyone, thanks for joining. It's 11 o'clock, so we'll get started now. Thanks for taking the time out of your busy day to join. So my name is Joe Van Gelder. I run Powder, a financial forecasting business, where we have built software to help companies build forecasts that support investment processes. We're here today to talk to you about how you go about building a forecast that's effective in communicating your strategy to banks, to PE, to any form of investor group that you're looking to approach. And we're going to go through, some of the misconceptions with building a forecast and some of the tips and tricks that you need to consider when you're doing that. So, with that in mind, I'll crack on. So just a little bit of background on me and the company, as I said there. So my background is I get brought in by PE and banks and advisors actually into portfolio companies to help them build investor-ready models to support transactions. I've been doing that for 6 years under my own steam, but I have a background in banking and in advisory as well. Powder is a software business which we launched about a year ago, which leverages technology rather than people, as a traditional consultancy would do, in order to make forecasting much more accessible and more affordable to all sizes of businesses. So we work with startups who are looking for their first round of investment. We also work with much more mature businesses that are going through more complicated financing arrangements with leverage finance, for example, ABL and other funding structures together. Our tool, because it's built on the software, we offer a full 3-statement model for between £50 and £200 a month, and we also provide consultancy alongside to help you with your fundraising process. So with that in mind, I'm just going to go through a quick agenda for what we're going to cover today. So here we're going to start with defining what forecasting actually is, because as I said at the start, there are quite a few misconceptions about what a forecast really means. We'll then touch on the use cases and the reasons why you might have a forecast in the first place. And then there are two sort of types of forecasts that people are usually familiar with. The one that we're going to focus on today is the 3-statement forecast. So that's the P&L, the balance sheet, and the cash flow. But some people are more familiar with the short-term cash flow forecast, and we're going to just talk about the difference between the two. Excuse me. Once we've got an idea of what forecast actually is and what the difference are between the two approaches, we'll talk about how you actually build one of these things, and that will separate into 2 groups. So that'll be forecasting the P&L, and it'll be forecasting the balance sheet, and we'll talk about the differences between your approaches in each of those circumstances. And then finally, we'll wrap up with some best practice action points, and hopefully there'll be a bit of time for Q&A as well, but we're on a reasonably tight time frame. So what is a forecast and what is forecasting? I used AI to help generate all of the photos in this webinar, and what AI has done is perfectly demonstrate and encapsulate the key misconception between people when they're building a forecast. So in this picture, you can see here a businessman looking into a crystal ball, looking into the future. And while he's looking into the future, he can see, I think, maybe a future version of himself holding lots and lots of money. And this is a common misconception. The idea of a forecast that people often see is, how much money am I going to make in the future? And whilst that is part of the reason for building a forecast, it's not actually the main. It's not actually the main reason. It isn't predicting the future. In fact, the one thing that I can definitely guarantee is that, you know, whatever you forecast in your numbers, the thing that it spits out at the end of the forecast is not going to be the thing that that happens in practice. You know, it is a statistical certainty that whatever you produce in your numbers is not going to be the thing that happens. So, you know, if we're defining forecasting as not predicting the future, and you're not going to be able to, you know, necessarily hit the things that you've put into your forecast, what's the point? That's the common question. What's the point in building a forecast if it's not predicting the future? And does that concept in and of itself mean that we shouldn't actually ever bother forecasting in the first place? The answer to that is no, absolutely not. Models are absolutely needed. They're really, you know, an integral part of the financing process, but they're not predicting the future. And what you'll see at the bottom here in this blue box is, you know, a key point that you need to take away, which is forecasting is making reasonable and defensible judgments based on the information available at the time. So we're not forecasting the future, we're not predicting what the future might be. Instead, what we're doing is we're creating a series of reasonable judgments that we're able to defend. And when we pair that, when we put that in front of a, you know, an investor group, we're able to go through each of those lines and come up with, you know, a reasonable answer to why we have made that assumption. And by stacking all of those reasonable judgments on top of each other, we're able to create overall a forecast that we defend. Now, some of those things are going to be missed, some of those things are not going to be, you know, achieved over time, but the important thing is that you've made a judgment that makes sense. So now that we've decided that forecasting is not predicting the future, we need to determine the use cases of when we actually need a forecast. And so I've put together here a spoke wheel with 7 different situations where you definitely need to have a financial model. You won't be able to sort of do anything or move through those processes where you don't have one. So if you're raising debt or you're raising equity, you absolutely need to have a model in place, because the investor group will need to, or the bank will need to understand, you know, how much money do you actually need, but also whether you can afford to repay it into the future. If you're planning to sell your business or you're looking to acquire a business, you have to have a model in place in order to make to go through the process and understand whether, one, you can afford it, and two, what the valuation might be. Lots of businesses of a larger size go through an audit process, and during an audit, you need to have a forecast in place to demonstrate that the business is able to trade over the next 12 months. So lots of businesses, when they hit a certain size, require an audit from a statutory basis, and therefore effectively require a forecast from a statutory basis. The next two along here, where we're talking about businesses that are struggling, so where there's cash flow pressures, or they're looking to do some sort of deal with their bank to change their debt structure. It sort of stands to reason, if you're tight on cash, you need to have a much greater focus on where your cash position, you know, might stand, and so you do need to have a forecast there. And then the next two are sort of slightly less mandatory, should we say, but it's good governance. And the good governance here is that if you have a business where, you know, a lot of startups are changing, you know, really regularly, or even in businesses that are going through large amounts of, should we say, external change, like COVID brought to the hospitality section, for example, you should have a plan in place which allows you to track, to test your, you know, different scenarios and work out where the business, you know, whether the business can continue to trade under its current structure. And then covenants on there, many sort of slightly more advanced banking documentations containing conditions and covenants. And these are effectively, sort of rules that you're signing up to when you're signing up to debt documentation. So I will not have more debt than I currently have, but on a mathematical basis. And so tracking your covenants, you need to be able to test whether your forecast strategy remains compliant with what you've signed up to in your debt documentation. The key point about all of these spokes is that models themselves are particularly powerful when you're communicating to stakeholders. So as we went around that spoke wheel there, a lot of that time is spent communicating your strategy to the stakeholders who have a vested interest in your business, whether that's now or in the future when they invest in you. And models are particularly powerful for making that communication. You're translating your strategy, your words, into numbers, into a quantitative basis. And that's really important for sort of putting measurable action points for businesses. I guess more fundamentally than that, though, every business should have a model. And now I would say that I come from a forecasting background. My business is in forecasting. But if you look around that spoke wheel of events where you absolutely have to have a model in place, well, most businesses will go through that one of those sort of stages at some point within their business life cycle. A lot of early stage businesses are looking to raise equity, some raising debt. Some later stage businesses are then looking to acquire, or they grow so big that they get to a point where they require an audit. Each business goes through those sort of stages. And even, if you do not grow or have the ambition in your business to get to that size, you need to be armed with the right tools to be able to make sure that you're ready for, new contracts or, changes in your business structure that might happen as a result of things that are outside of your control. So every business should have a model in place, but modeling isn't necessarily just planning for, what you should achieve into the future. So what's a three-statement model? I said at the start there are two different types of model that we're sort of particularly concerned with. One is the three-statement model, and one is a short-term cash flow model. Well, a three-statement model is a model where you are looking, or is a forecast rather, where you are forecasting all three statements of accountancy within the business. So you have the P&L, your profit and loss, you have your balance sheet, and you have your cash flow. And it is done in an integrated way, which means that they are sort of working harmoniously together. So what I mean by that is that all of the debits and credits work within the model, and different parts of the model drive each other with a single set of inputs. I was doing a model quite recently for it was a model rebuild actually for a portfolio company of a PE client of mine. And their original budget model had two different SONIA rates. So SONIA is like an equivalent of base rate or a cost of funds in a document. But there should only ever be one truth to what SONIA is. They had multiple different SONIA rates used in different parts of the model. And that didn't make sense. And so part of the model rebuild was making sure that each of these individual lines had their own sort of single input that drove other pieces, all the parts of the business. A lot of businesses, when they're constructing a model, only pull together a P&L, and that's not enough. It's usually the thing that people pull together because it's the easiest for them to conceptualize. That profit and loss is something that people are quite familiar with in general. A balance sheet and actually a cash flow as well, slightly more difficult things to conceptualize. But if you've only built the P&L, as we'll find out later on, you've only done a third of the work. And it's not enough, particularly when you're going for investment, to just stick to building a P&L. It's kind of a waste of time, actually, if you were to go to a bank or an investor with just a P&L forecast, because you've left out some absolutely vital information for the user to determine. So building a P&L by itself, not enough. You have to also forecast the balance sheet and also derive the cash flow, as we'll find out later on. So a three-statement model is looking at those three statements of the business. A short-term cash flow model is one where you're looking at the receipts and payments. It's a bit more like a bank statement. And so the flows resemble a bank statement, and it's really helpful, as the name suggests, at managing those short-term pinch points in cash. And they're different bases, and I've got a slide in a moment which shows the comparison between the two. But the short-term cash flow forecast helps bring out where management need to focus in the very, very near term. It doesn't necessarily convey their strategy in the same way as a P&L balance sheet cash flow business forecast does for a business. There is actually, often quite a lot of pressure put on from particularly non-financially minded founders or even some sort of stakeholders within businesses to create a three-statement model, so P&L balance sheet cash flow, that resembles a short-term cash flow model. So that's effectively looking at your bank statement over a much longer period of time than it's intended. A 5-year forecast for a short-term cash flow. It doesn't work on that basis because you don't actually have the tools within you to be able to communicate the strategy that's there. So a short-term cash flow, as the name suggests, should be used only in the short term. And so here on this screen, we can see the difference between those two approaches. So short-term cash flow, the definition of short term is over 13 weeks. Typically, that's industry standard, which captures 1 quarter of trading. It's usually built up on a daily or weekly basis. So again, looking at bank statements and looking at the daily transactions that are there and then projecting those forward. In an integrated model, a three-statement model, where you're conveying your strategy, the time horizon is typically 3 to 5 years. Some models do 7, particularly in the sort of the VC and early stage business forecast models. But 3 to 5 is a typical sort of timescale for a PE or bank transaction. And so those models are built on a monthly basis. And the reason it's built on a monthly basis rather than a daily or a weekly is because you have to forecast all 3 statements, P&L, balance sheet, cash flow. More often than not, a business will have a balance sheet that's available each month, or more periodically than that in some cases. But typically, if they're running a standard accounting system, they would be doing their bank reconciliations and creating a balance sheet every single month in order to provide it to their stakeholders and their management team. And because the information that underpins the model is built on a monthly basis rather than transactions in a bank account that you can see on a daily basis, a three-statement model is better built. It's usually built on a monthly basis rather than the other structure. And the other key point to the difference between the two, so if you've got a short-term cash flow that resembles your bank statement, an integrated model represents your financial system. That means the integrated model is built on an accruals basis, and the cash flow is derived from the movement between the P&L and the balance sheet. And what that means is you get an indirect cash flow. And we'll see what that actually means later on. I'll put it up on screen. But indirect cash flow reveals, the movements in your working capital extremely clearly. It reveals your capital expenditure and it reveals your debt payments all very clearly, which is important for structuring purposes. And that is different from a receipts and payments cash flow, where it's much harder to see how the flows are fitting together into those buckets. And at the bottom, you can see there the key use case, which we've covered already, but managing near-term, short-term cash flow and planning long-term strategically and raising capital. So which is both? Well, like this picture here of my AI generated, Kate Middleton sitting on a fence. I'm going to sit on the fence here. You need both of them. You need them to help with different things. So, and you should only use them for the right purpose. You should use a short-term cash flow model and structure to develop and manage your cash in a short-term time horizon. And for the longer term, you need to have a model that runs alongside it. Now, they should track and they should show the same sort of overall trajectory of the business. But they absolutely are used for different things and built on different bases. So there will be a difference between them, particularly in the sort of weeks to month conversion that you can get. What you can see on here, though, is a really clear graph, in my view, of some of the pitfalls of looking at the short-term period of a three-statement model. So in this graph, the greens are actuals and the blue is forecast. And you can see here that the overall pattern, so the ups and downs in the cash flow, are actually fairly aligned with the actual period. So you can see that there's some sort of seasonality within this business where there's a spike earlier in the year and a trough in the sort of third, the latter and the third stages of the third quarter of the year. And that seems to be resembled in the forecast. So what we've done is we've taken into account that seasonality pretty well. But the problem is that the average balance of this cash flow is down here. Whereas whilst this one is growing, which represents some of the growth, there's this big unwind in the first period. And what that first period, and I don't know whether you can see my mouse actually. I don't think you can. Here we go. I'll put it on the screen over here. On this side here, you can see there's this big unwind of cash, which is, seems just at first glance visually unrealistic in the business. And that's because when you're building a three-statement model, you have to go through several versions and iterations over time until you get to a point where you understand that sort of early stage release. And what you might find in this business, for example, is that they're assuming that people pay them more quickly than they actually do, for example. But when you look at a short-term cash flow model, it's actually much easier to sort of eliminate that sort of first month unwind of the balance sheet, mainly because you're not building it on that basis. And so what you should do is have both of them running at the same time to help guide and guard against that initial inflow of cash in this case, or outflow if you've done it the other way around. And what you'll find is that helps you on an iterative basis, comparing the two, to be able to create something that's more informative and more useful going further forward. And one of the things that you might find in terms of doing this work is that you find more data to support a better view of your cash in the short term. So now that we've defined what a forecast model is, and we've defined how we've defined what a forecast is, we've defined where we need a model, and we've also defined the difference between the two different approaches. How do I go about building one? So building a three-statement forecast is effectively, in the broadest sense, driven by 3 steps. Step 1 is you start with the P&L, which is something which I think a lot of us are familiar with, but we'll talk about that a bit more on the next few slides. Once you've built a P&L that you're happy with, you need to form a link between your P&L and your balance sheet. And so the broadest sense of that, you'll say for your revenue, for example, your revenue is always connected to your debtors being how quickly people pay you. And so you need to form and establish a link between how your P&L is going to impact your balance sheet. And by creating that link, you're effectively flowing through the machine from P&L down to balance sheet, down to cash flow. And then step 3, the cash flow isn't something that you forecast itself specifically. It's an output of the assumptions that you make on the P&L and the balance sheet. And what you do is you derive the cash flow as the movement between the P&L and the balance sheet. Now, obviously, I can't take you through all of the technical points in building a model in just an hour or in a webinar setting. It's a specialist thing that takes a long time to master, or you can use my software, I guess. But it's something that sort of takes a period of time for you to actually develop. But the principle is something that you need to understand, because if you're building a model either yourself or you're building a model with an advisor, you need to appreciate the reason why you need to forecast both of those, both the P&L and the balance sheet, in order to get a cash flow output. Here on screen, we've got an example of a P&L. What I would say for anybody who's watching this now or later, that these numbers are completely made up. They're not a real business. There wasn't a company that moved from 52 million revenue up to 89, back down to 55. It's nonsense. So there's no sort of confidentiality issue here, but equally, because the numbers are nonsense, they wouldn't necessarily be representative of a true business. It's more to draw out some of the key themes that are here. And the people who are on this webinar, there's a real mix in terms of, you know, sophistication from some investors all the way down to some startups. So I'm going to just treat this as a sort of an early stage business learning, some of the stuff you might already know in this. But the key point on this slide is that profit does not equal cash. And that's one of the core principles as to why a P&L is, is not enough for an investment round or for raising debt. And I can prove that sort of immediately from this slide. When we look at the first row on our P&L, we can see revenue. Revenue is is sales, but excluding VAT or sales tax if you're not in the UK. So VAT is excluded from my revenue. So from moment one of looking at my P&L, I know already that there's an element that affects my cash flow, tax, VAT, that is not displayed here. And that does have an impact in terms of how much cash I have in the bank month to month. So even before we get down into things that are much more complex, the first line of the P&L demonstrates pretty clearly that you have to start looking at the balance sheet in terms of your forecasting as well as the P&L. So if we run down those lines sort of very, very high level, so that everybody understands what we're looking at. At the top, you've got your revenue. So this is how many the money that we've generated from sales. So if I have a pen that I sell for £10, this is those pens. Each pen that I've sold over that time for £10 is flowing through my revenue up here. I then have my variable costs, and those are the things that effectively costs that I incur in order to drive the forecast itself. And so what I mean by, to enable the sales. So if I'm selling pens for £10, I might have to buy the pens for £4. And so therefore, every pen that I sell, I generate £10 of revenue, but I have variable costs of £4 per pen. And that gives us this line here, which is called our gross profit. And that's effectively the profit that we make from actually selling the items. Below that, we have our overheads, which are more fixed in nature. And because they're more fixed in nature, they're effectively much less variable. They're much less, they move much less frequently than your gross profit would be. And so a typical forecasting process would be looking at your overhead bucket and determining how much variable cost you have, variable, so revenue and variable cost that you need to put through the machine in order to cover your fixed overhead. There are some other lines on here that don't affect cash. Depreciation and amortization are a key line item there that doesn't affect cash. This is effectively demonstrating the economic benefit and expensing economic benefit of an asset and expensing that over time through the P&L. We have interest expense, and some of that might not have been actually cash paid during the time. And we also have corporation tax, which tends to be delayed by 9 months from the point in which it's recorded. So there are various sort of differences here between what my P&L is showing and where my cash actually ends up. Going back to the structure of the P&L, we have here the revenue, the variable costs leading to gross profit. We take off our overheads, and that leaves us with this line here called EBITDA or EBITDA. EBITDA is a sort of a comparative tool that we use. This is our earnings before interest, tax, depreciation, and amortization, and it's a really handy profitability metric to compare across different companies. And you'll often hear when we're talking about, you know, the valuations of businesses, you'll hear people say, oh, I had a multiple of, you know, 5 times, 3 times, whatever it is, 7 times of EBITDA. And that is something which is a profitability metric that is, you know, has the sort of effects of things like depreciation, non-cash items, things that affect the true picture of your P&L stripped out of them. So how do I go about forecasting the P&L? Well, more often than not, revenue is the key driver of forecasts. And it goes back to what I was saying before. If I'm able to generate this much revenue, how much cost, can I afford to have in the business? How much overhead can I have in the business? And that's a lot of businesses operate on that structure. So they create a forecast based on their best view on what revenue might be, and then they layer on the cost that they can afford as a result of that revenue strategy. Or the alternative is, and this is different businesses have a different structure, is saying I've got these fixed costs within my business. How much revenue or how much volume do I need to put through the business in order to cover those fixed costs? Now, a good example of that would be like a professional services business where you might have, you know, an accounting function, you might have an HR division, IT, so on and so forth. But you also might have, you know, a number of fee earners as a set of consultants, and those fee earners have to do a certain level of volume in order to cover the cost of actually having them on board. Either way, the blue box it says exactly what you need to put forward, which is you need to be able to communicate clearly how a business makes money. So here I'm going to give some examples of some key performance indicators depending on, you know, different business types, and that's something that's really important for communicating your strategy to your investor group. So here, this is me as a software house. So my key performance indicators that drive my revenue and communicate how I'm growing my business are the number of subscribers I have to my platform, the price of that software in the first place, and how well I'm able to retain those customers and subscribers to my business. Without those sort of key performance indicators underpinning my revenue forecast, any investor is going to say, well, how are you actually building up your forecast? And so in order to de-risk my revenue plan, I need to embed these key performance indicators in the structure. So a hotel, the key performance indicator here is going to be the occupancy and the price of the room. So how many rooms do I have in total within my hotel? How full up are they with customers? And how much am I charging on an average basis for each of those rooms? Here we have a set of lawyers. This is AI generated. This is not my view of lawyers for anybody who's a lawyer on the call. But just as I gave the example up here, how many fee earners do I have within the business? How utilized are they? And how much am I charging them out at? It's actually very similar in structure when you break it down to a hotel. It's how many things do I have? How well am I using them? How often are they sort of economically active? And how much am I charging them out for? And here we have a manufacturing business. So the key performance indicators here include things like the number of items sold and the price of those items. There are other key performance indicators, some more operational factors that go like a level below what I've just said here. So a manufacturing business might, for example, have throughput. So how many things are going through the machine per hour, wastage, efficiency. There are other KPIs that get built into it. I think the common point that I wanted to draw out here is that there's a difference, even though there's a sort of a difference in structure of those KPIs, they kind of all boil down to the same sort of key issues, being how much of something am I going to sell and what price am I going to sell it at? And that's absolutely critical for all businesses, particularly in an environment where inflation is high. If you've got a business where you've got revenue just growing by 5% each year, an investor or a bank might just say to you, well, hold on, how much of that is inflation driven? So you're raising your prices to your existing customer group, and how much of that is driven by you going out and seeking new customers? And so by separating out those two things, you can show the difference between, you know, from a revenue perspective, between your volume growth and how much you're changing in terms of your pricing structure. Really important to communicate and help de-risk your forecasts. So we've looked at revenue there, and it doesn't really matter, you know, what you choose. The important thing is you need to articulate how the business generates money in the first place, and using KPIs to underpin that helps sort of visualize and track and articulate how you're going to do that. Here are some other thoughts about how you would go about building a forecast in terms of the cost lines and other points. So, you know, do I have enough sales staff? So if you're showing a big growth in your revenue, you need to be able to defend that. Go back to our very first point about creating a series of defensible judgments. You need to be able to show, well, my sales aren't just going to go up because people like me. They're going up because I'm making some sort of active decision or investment in order to drive that growth. So it could be, do I have enough sales staff? What's their activity like? Are they making 2, 3, 4, 5 sales? What's right on that basis? I'm just going to skip one there. Do I have enough advertising put in? So there are some businesses like online clothes retailers or online retailers in general, where your advertising is more driven by online presence and an investment in things like pay-per-click. How will that drive my sales? Do you have any data to look at in terms of conversion rates between your advertising and your sales in your historical period? Do I have enough people actually to deliver the revenue? So, you know, with the fee earner point in terms of the staff, if I've shown a big growth in my revenue, but I haven't matched that to my headcount plan, do I actually have enough lawyers in that previous example to be able to deliver the revenue that I've got in my forecast? And that doesn't actually just have to be professional services. It can be more sort of simple things. Do I have enough, you know, people within my customer support team in order to help this, you know, massive increase in my customers? It's all quite intuitive stuff, but you have to think about each of them sort of line by line and make sure that they're joined up. We talked about the difference between volume and price and how inflation can affect that. The last line there is changes in overheads. This is more to do with mature businesses that are looking at some form of structural change in where their costs sit from an overhead perspective. And so if you're moving from a place where you've got overheads of £5 million and you're showing in your plan that overhead drops to 4 million, or even it stays the same, that you've got this massive sort of uptick in your revenue, you need to be able to defend what you're doing and your changes that you're making to your efficiency effectively as a business in order to put that through. So I'd always say that, you know, when you're building a forecast and you're looking at your overheads, show the strategic changes that affect your overhead amount, and defend it in as much detail as you would do in defending your revenue forecast. And the line at the bottom that's absolutely critical is that, and this is more to do with the bigger businesses and the sort of later stage businesses than it is in early stage, is wherever you can, use historical information to anchor your forecasts and demonstrate how you are improving upon what you've already delivered. And that's, again, it's about communicating your strategy, but the more you can anchor it in reality, the more defendable it is as a forecast. If you're a startup and you don't have that defensibility in your forecast based on delivery, look at comparables, look at businesses that exist in the marketplace today, what they're, go onto Companies House or any other sort of free resource there, and see what sort of margin they're making it at an EBITDA level, and say, right, well, maybe I'm not there because I'm a small business, but my plan is over the next 5 years, I'm going to put enough stuff through my enough volume through my business, and I'm going to construct my overhead structure such that I'm going to then later mirror what they actually deliver in their current state. So wherever you can, try and de-risk the forecasts by having some sort of benchmarking, some sort of data that helps fix that. This is an example of the balance sheet, and what you can see here on screen is a definition of a balance sheet with lots and lots of different categories within it. The definition being that it's a snapshot, it's a photograph, it's a moment in time view of the company's assets, liabilities, and capital. So going down that sort of one by one, we're looking at our assets. That's things that our company owns or is owed by other parties. So for businesses where you've got a high investment in equipment or capital expenditure, you'll see those in the fixed assets section up at the top. These are things that you are using your capital to buy. They're not on your P&L, so it's another reason why your P&L is different from your cash flow. These are capital assets. They could be buildings, they could be equipment, they could be computers, anything like that you can physically touch. There's also intangible assets, but we're not going to sort of go into that in this talk. And then you have your current assets, which are, as I say, more like things that you are owed. Some simple stuff that we all sort of recognize. Inventory is stuff that we own, but it's there on a short-term basis. Debtors is money that's owed by other parties. When we look at our liabilities, I would typically say that you should split your balance sheet from the investor relations perspective into your liabilities relating to your trading business, and those are creditors, where you owe people money, and tax items, as you can see on the screen here, and separate out debt as its own bucket. And that's really important because debt is something that can change depending on what your capital structure looks like. So I would always separate out the debt element into its own sort of bucket. In terms of the capital section, the equity section, theoretically, this is how much your business, if everything is liquidated and you get to the end, how much will be returned to shareholders. It's much more of a theoretical thing than it is in practice. So the equity section does need to balance, and it does need to make sense, but it's not as clear cut in terms of your cash generation as maybe some other parts of this are. The key point in the blue box there is that every single line in the balance sheet needs to be modeled individually. So you need to go down your balance sheet and be able to say how you think those items will move, either by connecting it to your P&L, as we saw earlier on in the process, or by by analysing the individual account nominal codes that are there and understanding what makes them up and how they will affect themselves. I put an arrow there against prepayments. It's really just to highlight the fact that there are some items on more mature business balance sheets that require a bit more thought to them, because they aren't necessarily as intuitive as saying someone owes me money or I owe people money. I think the thing that you need to consider here is that when you're looking at lines like prepayments or accruals or deferred income or accrued income, anything that is slightly less sort of straightforward or mainstream, is that you should go into those account nominal codes and try and use trend analysis to determine how much of the items that are within there are fixed and how much are more more fixed in nature, and how much vary based on your P&L, and try and articulate that through your modeling. So for the same businesses, we're just going to look at the key items in the balance sheet that are going to be important, and where an investor might focus or a bank might focus. So for a software business like mine, the focus is going to be on deferred income. There's there's going to be a real sort of view on how much money I've taken either upfront or I'm taking on a monthly basis, or making sure how my revenue matches my actual cash conversion, or my revenue recognition matches my cash conversion. For a hotel, it's actually quite similar. You have deposits. People pay for their rooms maybe in advance, or for weddings, they pay for that many months in advance. So it's, again, looking at how much cash I've already received on the basis of delivering revenue that I have not yet recognized. Just conscious of time, so I'm moving through this reasonably quickly. We have here the firm of lawyers. The issue is going to be work in progress, so items that we haven't yet billed for, but we are about to, or that we have incurred in terms of our costs. Understanding the relationship between our revenue, our cash, and our work in progress is going to be really important for a set of lawyers. And then when we look at manufacturing or retail or anything like that, the key area is inventory, where cash is tied up. And so what you need to be able to do is articulate in the business with inventory how much you are buying in advance of selling it later on, and therefore how your working capital is tied up. Here's a picture of me looking very, very disappointed and confused, and I don't think you need to feel like that when you're working on the balance sheet. The key points on the screen there are some tips and tricks to working out how you go about building an assumption for your balance sheet. So you need to look at your trend analysis, as we've already covered. We've already covered the fact that your debtors and certain things are already sort of self-standard linked to your P&L. You do need to understand your debits and credits if you're building a fully functioning forecast model, and in more complex businesses where that becomes really, really relevant, you should always look to using a professional to support you in building that. There are software packages like Powder that help deal with the debits and credits for you so that you don't have to worry about them. But the important point is that you need to be able to show how your balance sheet in particular is impacted. Don't forget your CapEx or your tax. We do have to pay tax. So if you're a business that's showing, super profitability over time, there is going to be a cash impact in terms of your tax that's paid. So you do need to show, that. You do need to show how much you're spending in capital assets, even if you're not a business that relies on them to generate the revenue. And don't get bogged down in sort of detail that is unnecessary. Depreciation is non-cash. It doesn't really affect the model. You put it as £1 million for or 100,000. It doesn't really impact it. You should try and make it look sensible for so that it doesn't distract from what you're actually doing. But ultimately, it doesn't impact things. And there are other lines in the P&L and the balance sheet that you need to sort of take a pragmatic view on. Very quickly here, this is an example of an indirect cash flow, which is what you would expect in an integrated model. Here you can see pretty quickly is the different categories that are different from receipts and payments cash flow. So this top section here, you've got your profitability from your P&L, your EBITDA that we talked about before. You then have a bunch of working capital driven movements from your balance sheet, which shows effectively how your balance sheet is impacting that profitability. And so in this business, some of those movements are really quite meaningful. And your working capital is important because that is a timing difference in terms of your cash generation, but you can also get funding for it. Working capital is funding. It is clearly identified and readily available. Things like invoice discounting facilities, even inventory discounting facilities are available, or an overdraft. So being able to separate out what your working capital is from your, should we say, your performance-driven and long-term cash flow is really important. You can see here your capital expenditure and any equity injections or dividends that are within the business. That's important for understanding, how you're using your cash to invest in the business. And then that gives you a line here called cash flow available for debt service, which is really important when you're structuring debt in particular. And that's your cash flow if you didn't have any debt in place. And theoretically, that's how much the business could afford to pay, if it was maxing it out each period. So in this business, in March 2024, in theory, it would have enough cash left over to pay down at least 9 million of capital and interest. Now, you wouldn't soak up all of that, but it does give a really good rule of thumb for you to be able to say, this is how much my business might be able to afford if the other metrics that are there for that. And that's why it's really important to structure it in this way for a debt provider. We've already sort of covered the fact that forecasting is inherently volatile and you can't predict everything. We said that right at the start. Here are some 4 reasons why that might be the case. Clearly there's in uncertainty. We don't have crystal balls in place, so there are things that can change that are outside of our control. War on Ukraine, COVID. These can really disrupt forecasts, and they're particularly pronounced in certain industries, as we felt during that COVID pandemic in particular. So uncertainty is something that you need to have, in the back of your mind when you're constructing a forecast. It can't just be to the letter, to the number, the amount that you need to achieve. You need to build in some fat as a result. A lot of smaller businesses in particular, but also a lot of big businesses have issues with data quality. And this is the single biggest controllable problem for me. It happens a lot, and you need more discipline, especially as we're sort of entering an increasingly digital age in terms of our recording and our reporting. I'm currently working on a large-scale data improvement exercise for a telecoms business at the moment, and it's really frustrating to see how that can seriously impede progress. It's not just on the modeling side where the progress is lost, it's in the business in general, and it takes a lot of time and a lot of cost for very expensive professional people to try and correct that or explain it. And so if there's one thing I would recommend that you take away from any part of this talk, is to make sure that you start to analyze, understand, and structure your data much more clearly. It will only benefit you over the long term. Overfitting is the over-reliance of historical data. I did say before about how historical data should inform your forecast. That's absolutely true, but for the reasons that we just heard in terms of the uncertainty and the next one, which is changing trends, you can't rely too much on historical data. It's a balance that's there. So what you need to do is adjust your historical data for the current themes that you're seeing and changing trends. We're living in an era where AI, for example, is taking is sort of the next industrial revolution. We have all sorts of other sort of technological advances that are being made. We need to factor them in our forecasts and make sure that we've captured the impact of those, because any investor is going to ask you, if you're a business that's threatened by AI, they're going to ask you, for example, how are you embracing it? How are you preparing yourself for it? So take into account those changing trends in your forecasts. Very final slide here, and I'll let you go. So this is something that's really important. You shouldn't just do a model just for a single process or a single budget or a single point in time. You shouldn't, as this AI-driven picture is showing, you shouldn't just pick it up and stick it in a drawer. You need to review it each month, and it's good practice to do, to update it for actuals each month as they become available. You should run variance analysis. You should be able to look at the impact of things like external factors that are coming into play, like like AI. You should see a high case, a low case, an adoption case. You should look at the differences between your model, your forecast that you have in the model, and what you actually deliver over time, and analyze the difference between permanent and timing. And this will help you, if we go back to the graph, create something that's much more aligned with reality over time. So you're refining your forecast based on the analysis between the updates each time you go on. Very simple thing, but take a step back and think, do any of these numbers look odd when I've built it all up? If they look odd to you, they're going to look odd to an investor, they're going to look odd to a bank. So take a step back. Do these numbers look odd? And if they do look odd, but there's an explanation for them, that's absolutely fine. Put through the explanation, explain that, write a bit of commentary to say why it looks like that. But you need to be able to have that answer to hand, because if you don't have it to hand and it does look odd, an investor, banks can pick that up. Use ratios, benchmarking, any other sort of financial analytics that you can do. Our tool draws out those ratios and those analytics for you in forms of dashboards. It's really important that you do that, because it allows you to review and critique your forecast before an investor does the exact same process themselves. And then finally, make sure that you look at these different types of scenarios and categorize them. And that's it. I think we've actually run out of time on that. I'm not sure.
We are out of time. We are out of time, I'm afraid. But thank you for everyone for joining. We don't actually have any time for any questions before the webinar cuts us off. But if you do have any questions, then you can get in touch with us via our website at www.powder.co.uk. Also, if you are interested in a free demo, you can sign up to that again via our website, and we can talk you through how we actually might be able to help you depending on what your business need is and where you are in your journey in financial forecasting. Thank you very much, everyone, for joining us today.
Thank you. Thanks, guys. Bye.